Imagine you are watching a Bollywood thriller. The suspense builds, the music swells. You are on the edge of your seat, wondering what coming next. Now, what if I told you that the stock market has its own version of suspense? It's called Vega, the Greek that measures your exposure to uncertainty and volatility. Today, we are going to deep dive into Vega, the hidden force that turns markets' unpredictability into trading opportunity. Ready to ride the wave of volatility like a pro? Let's go. So, what's exactly Vega is? In simple term, Vega measures how much your option price changes when the market's implied volatility changes. For example, ICICI is trading at 2000. You are looking at a call option price at 100 with a Vega of 1. Now, if the implied volatility increases by 1%, your option price rises by 1 rupee. If IV jumps by 10%, you will gain 10 rupees. That's Vega in action. It's your sensitivity to market's uncertainty. Just like how suspense makes a movie exciting, Vega adds value to option when the uncertainty rises. Now, here is where it gets interesting. Not all options have the same Vega. At the money options have highest Vega. Far dated options have more Vega than the near dated one. Think of it like a cricket match. The longer the game, the more room for twists, turns, and surprises. If you buy a long dated option with Vega 3, even a small IV spike can lead to a big profit. But for short term options, lower Vega and more exposure to theta and gamma instead. That's why Vega is a tool of choice for traders who want to capitalize on the market uncertainty. Here is a key takeaway. Vega is your friend in an uncertain market. Say ICICI announce a bad quarterly results, market volatility spikes. If you were holding a high Vega option, you could see substantial gain. But remember, Vega work both ways. If implied volatility drops, option value drops too. So, understanding Vega isn't optional. It's essential to manage risk and spot opportunity. I know what you're thinking. How do I use Vega to my advantage? Here is the secret. Vega is like a weather forecast for market. If you expect a stormy conditions like earnings, RBI announcements, global events, buy high Vega options and prepare to profit from the surge. But if the skies are clear and stable, avoid high Vega positions. You might just be paying for suspense that never comes. Vega is your volatility radar. Use it to navigate uncertain markets and turn suspense into success. Now, let's put your learning to test with these 5 quick questions. Question number 1. What does Vega measure in option trading? A. The time decay of an option. B. The change in options price due to the stock price movement. C. The change in option price due to the change in implied volatility. Or is it D. The change in delta as the stock price move? The answer is C. The change in option price due to changes in implied volatility. Question number 2. What happens when implied volatility increases by 1% if option has a Vega of 1? A. The option price increases by 1 rupee. B. The option price decreases by 1 rupee. C. The option price stays same. Or is it D. The option price increases by 10 rupees? You guessed it correctly. It's A. The option price increases by 1 rupee. Question number 3. Which options typically have the highest Vega? A. Out of the money option. B. In the money option. C. At the money option. Or is it D. Far dated option? The answer is C. At the money option. Here comes question number 4. What should you do if you expect a market volatility to increase? A. Avoid trading option with high Vega. B. Buy options with low Vega. C. Position yourself to benefit from the volatility by buying options with a high Vega. Or is it D. Sell all options? The answer is C. Position yourself to benefit from volatility by buying options with high Vega. Last but not least, question number 5. What happens to an option's value if implied volatility decreases? A. The option value increases. B. The option's value remains same. C. The option's value decreases. Or is it D? The option becomes unpredictable. The answer is C. The option's value decreases. Share your quiz score in the comments. I'll personally check and help you level up your volatility game. If this video helped you demystify Vega, share it with a fellow trader who is still trying to understand and make sense of market volatility. In the next lesson, we will understand delta hedging and show how to build smart trades. Until then, keep learning, keep winning.